Deciding which stock to buy when you're starting out as an investor can be difficult and at times very overwhelming. Luckily, we can help you decide by introducing you to several different options that are available in the stock market. Maybe you're someone like Sandra here, who's looking to invest over a long period of time and then you forget about it. Maybe you have a busy daily life, or you just aren't really very interested in finance, but you'd still like to invest. If any of that rings true, an index fund or mutual fund may be perfect for you. Quick reminder time. Index funds are a basket of stocks like Apple and Microsoft in one fund. Mutual funds are also a basket of stocks, but actively managed by a fund manager. Back to it. The S&P 500 index fund is the most popular that investors typically invest in. It requires little work after the research that you do before you purchase it, especially if you're investing over a longer period of time, as you wouldn't have to consistently follow how the markets are doing. Imagine the stock market is a bit like the weather. You can predict the weather seasonally, with the summer months typically being hot, and in the winter months it'll typically be cold. However, you can't really tell day to day what the weather will do, as it can sometimes go against the predicted weather forecast. The stock market is similar in the sense that the market goes through seasons depending on the entire macroeconomic environment, which makes it easier for investors to prepare. However, day by day, like the weather, it can be unpredictable, making it very hard for investors to time the market just right. You can't time the stock market, and no one has a crystal ball to tell them how the market will perform. So the best way to start investing as a beginner would be DCA, or dollar cost average, which is consistently investing a specific amount into the stock market over a long period of time. This means that you're buying when the market is going up and when the market is going down, so on average you're getting the best price. This method is the same regardless of which currency you use, but we're going to stick with dollars, as that's the world reserve currency. Let's take a look at an example of what dollar cost averaging would look like for an investor like Sandra, who wants to invest $200 every month into the S&P 500. Sandra can either invest the full amount on a certain day of the month, typically on the day she gets paid, or she can split that $200 into 4, so she can invest $50 every week. Deciding if you should invest weekly or monthly doesn't matter. What matters is that Sandra is investing a certain amount per month on a consistent basis into the stock market. But not all investors are like Sandra. Perhaps you're an investor like George, who's nerdy with his finances and has a tendency to be adventurous with risk. Perhaps growth or disruptive individual stocks may be an option that an investor like George would like to invest in. Quick reminder that growth stocks are companies that are expected to grow in sales and earnings at a faster rate than the market average. Some growth stocks are also disruptive stocks. An example of this is Tesla. Disruptive stocks are companies that improve or replace existing concepts that take away competitors' market share. Let's use Tesla as an example of a growth and disruptive stock. Tesla has disrupted the car industry by being the market leader of electric cars. The world has taken environmental issues more seriously in recent years by making radical changes across several sectors including the car industry. The world is moving away from petrol and diesel powered cars to electric. This makes Tesla disruptive because established car companies like General Motors and Ford are struggling to compete for market share against Tesla in the electric vehicle market. Other examples are Apple, Netflix, and Amazon, who are disruptive in their own industries. George may be tempted to invest in growth and/or disruptive stocks, which are popular amongst investors because they have the potential to produce high returns despite being very volatile stocks. Investing in individual stocks does require work even after investing in the stock. You have to follow the performance of the market as well as how well the companies you're investing in are performing, such as through financial reports. Despite George's interest in the stock market, he's thinking he'll invest in index funds. He believes he wouldn't be able to devote enough time in the long term to track the performance of all the individual stocks he'd be invested in, especially as he'll become a father in a few weeks. George also thinks that he'll hit that like button for the YouTube algorithm. You might possibly be a dividend investor like Doris, who likes the sound of investing in individual stocks, but she's quite averse to risk and is looking for an alternative income source rather than her job. Value stocks may be an option for Doris here to invest in. According to Forbes, value stocks are typically predictably profitable companies that often pay attractive dividend yields. This is why value stocks trade at lower and less volatile prices compared to growth stocks, as they produce predictable returns. They also use their profits to pay shareholders rather than reinvest their profits back into the business so it can grow. An example of a value stock is Target and JP Morgan. If Doris was to invest in either of those examples, it would provide her with an alternative income source because they both provide dividends to shareholders. Value stocks also tend to be more mature businesses, which already have steady growth rates and report stable revenues and earnings. This ultimately makes them low-risk stocks, as they're not volatile, which suits an investor like Doris, who opposes too much risk. If Doris wanted to reduce her risk one step further, she could diversify by having exposure to global value stocks within her portfolio. If Doris isn't aware of many global value stocks, then perhaps a global index or mutual fund with a good track record may be an option for her. An example of this is the Vanguard FTSE All World High Dividend Yield ETF. This ETF contains over 1,800 stocks across various regions such as North America, Europe, and emerging markets. Perhaps you're a type of investor like Amelia, who wants to reduce her risk as much as possible by diversifying her asset allocation. One thing Amelia could do would be to buy well-diversified index funds. By the sound of how diversified Amelia wants to be, an option may be to invest in index funds across many different asset classes. There are many types of ETFs that are available to Amelia on the stock market that have exposure to different asset classes. Examples of these would be the Vanguard FTSE All World ETF, which contains companies from developed and emerging markets. This type of ETF provides Amelia with a broad range of global stocks. She could also invest in bond ETFs, such as the Vanguard Global Aggregate Bond ETF, and finally the iShares Core US REIT ETF, which will provide Amelia with a broad exposure to American real estate. The more an investor like Amelia diversifies their asset allocation within their investment portfolio, the less of risk they'll take on. However, it's important to bear in mind that the less risk you take on, the lower the reward might be. If Amelia wanted to diversify further, she could also look to invest in other asset classes like commodities such as gold or cryptocurrencies like Bitcoin. As a beginner, are you an investor like George, who likes to take on a lot of risk but seek that higher reward? Are you an investor like Sandra, who wants to invest and forget about it, allowing her money to compound and grow over time without having to constantly check up on it? Perhaps you're an investor like Doris, who seeks an additional income with relatively low-risk investments. Or maybe you're an investor who doesn't like taking on risk at all, like Amelia, and is keen to diversify amongst various asset classes. And if you couldn't relate to any of those people above, that's okay. Everyone's different, you just have to think about what type of investor you want to be. Then research into the right options that are available to you and just begin investing. However, if you're still unsure where to invest, you can always find out by clicking on this next video.